Welcome, everyone, to another series of Let's Talk Real Estate Investing. In this series, we will share experiences, knowledge, and learning from other real estate investing professionals and experts, including myself, to help empower you to build your own real estate investing strategy, and including tools and processes so that you can scale efficiently. My name is Debbie Balfour, and I'm a real estate investing success coach and a professional real estate investor. And I help real estate investors build their personalized real estate investing strategy and scale efficiently so that you can start enjoying your financial freedom and your time freedom more than anything else. Each of us are unique, so our strategy should be unique to us. I'm really excited today to introduce to you my special guest, Klint Rodgers. Now, I'm going to read a bit about Klint here, so bear with me. I'm going to read the screen. Klint works for a corporate finance company called Access Capital, which is an investment fund manager, registered portfolio manager, and an exempt market dealer. Klint himself is a registered dealing representative with Securities Commission in BC, Alberta, Saskatchewan, and Ontario. So each of those have their own security rules, and that's why Klint has to be registered in those, and those will be the places that he can serve. In that, he represents 15 to 20 private real estate and alternative investment firms that are registered RSP and TFSA eligible. The fun fact about Klint is that today's actually his birthday, and I really appreciate appreciate that he's making this podcast a priority on his birthday. So happy birthday, Klint! And Klint's topic today is related to investing in registered funds in private markets. So, Klint, do you want to give us a little bit more about yourself, and then we can dig into, um, you know, all about registered funds and those private markets?
Absolutely. Thanks so much, Debbie, for the birthday wishes and inviting me out this evening. Hello, everybody. As Debbie mentioned, my name's Klint Rodgers. I happen to be a dual licensed advisor, both in the private capital markets and on the insurance side. For today's presentation, obviously, we're going to focus on education as opposed to diving deep into any of the product offerings. So as it relates to my role, I am the national team lead with Access Capital, a branch administrator running a team of advisors underneath of me with a boutique dealership that's been around about 20 years. So looking forward to today's podcast and hopefully giving you a few educational tidbits that will get you that much further ahead in your goal of retirement and financial freedom.
Awesome. Thanks, Ken. So before we dig into it, I think there's this stereotype out there, two stereotypes. That number one, that registered funds can only be used for stocks. A lot of people just think that I give my registered funds to a financial advisor, and they do it in stocks. And then the other stereotype is that real estate investing is properties, and you have to be a landlord. So I want, as we cover these things, I think you're going to blow those myths out of the water.
Absolutely.
So what type of opportunities do you represent that exist in these private capital markets that we can use our registered funds for?
Yeah, great question. So pretty much anything you can think of, from residential to industrial, commercial, REITs, mixed, self-storage, care homes, car washes. We represent a number of debt funds, flow-throughs, everything from oil and gas to ag funds. But the bulk of what we truly do represent, as listed on the screen here right now, is in the real estate arena. So you know what? If you like toilets and tenants, fantastic. But if you don't like dealing with them, we have a number of REITs that we represent, real estate investment trusts, a number of mixed mortgage investment corps, and of course, a number of developments and other opportunity within the real estate sector, all across Canada, the US, and Mexico, and almost all RSP TFSA eligible.
That's really awesome. So we can see there that we have choices so that real estate is not about you don't have to be the landlord. You don't have to be up at nights and waiting for those calls. So you can invest passively and you can use your registered funds uh, you know, to do that, to invest in those things. I love some of the things on there. Some of the things that I'm passionate about is I like seeing the self-storage. I love the care homes part of things. So you can actually invest based on your values and without doing any of the work.
Yeah, absolutely. And, it's a fascinating marketplace that has grown exponentially over the last 14 years since really something called National Instrument 31103 came into place, which set out rules, regulations, and guidelines for dealerships, dealing reps, and issuers to follow. And it really changed the Canadian landscape on how we invested. And, what was once reserved for high net worth, pension funds, institutions is now accessible to the average Canadian investor like you and I, with as little as 5, 10,000, or even $25,000, be it in personal, corporate, or registered money, RSP, TFSA, locked in pensions.
So speaking of that, that anybody, even the small guy can get into. Can you speak more about how you become eligible for these investment funds?
Yeah, absolutely. I mean, there's different rules and regulations for each province, as you mentioned, but pretty much it boils down to four different categories of real eligibility. One is basic investors. If you're over 18 and have a heartbeat, you can invest up to $10,000. Needless to say, typically we don't have too many youth that are jumping to the gun with a bunch of money to invest. But after that becomes an eligible investor. So eligible investors are those that have $75,000 in income before taxes, or $125,000 in income with their spouse before taxes, or $400,000 in total net worth. Those individuals in most provinces are allowed to invest up to $100,000 per 12-month period. With the exception of in BC, where we're a little bit more liberal and you can invest more than $100,000, again, based on suitability, concentration, and diversification. And the last two categories, just quickly, are accredited investors, which typically are earning $200,000 or $300,000 with their spouse, or have over 1 million in net financial assets, or over 5 million in total net worth. And they're really, have the luxury of investing a little more and doing, for the most part, what they want to do. But again, based on a dealership suitability, concentration, and diversification. And the final category, which many people aren't aware of, is more reserved for, higher net worth, ultra high net worth institution. And that is permitted investors who can waive suitability and essentially tell the advisor, I want to do this with this much. And we don't have to question them so long as they're worth more than 5 million in net financial assets or more than 25 million in total net worth.
And a lot of these are to protect the uninformed investors. So that's
Absolutely. And that's a great point. You want to watch in the marketplace for individuals that are selling their own product. I'm not saying it's good or bad, but again, if someone is introducing their own product, you have to question also, why aren't they on a dealership shelf, right? Why hasn't it been vetted through and approved? And it could just be a matter of they're smaller and they're trying to get going versus, maybe they're larger, but they're focused on selling versus educating. So, I would always suggest that someone reach out to a registered dealing rep or IROC advisor for more information pertaining to any offering to make sure it's the best suited for them.
So can you help us explain? So I mean, why would somebody choose to invest in REITs and like in these private markets instead of stocks? Like, what's the advantage?
Yeah, that's another great question. And one of the advantages to the private capital markets is the fact that we can reduce, if not eliminate, depending on the specific investment, a lot of the volatility. So, the slide I'm sharing here right now is known as the MSCI Real Pack Index. And essentially, it started tracking Canadian private REITs dating back to 1986. And you'll notice they've never had a negative year, which is incredible, considering that these are passive investments that mostly, for the most part, are paying monthly and also have a not just an income component to them, but a growth component as well. So, in short, by giving up a little bit of time and liquidity, the ability to push a button and get out of your investment instantaneously with that so-called patient capital, those two big risks become your biggest rewards or advantages, allowing you again to reduce some of the volatility and hopefully increase the overall rate of return.
Yeah. So, I mean, there's like, a lot of people in the corporate world, they think that, like, oh, I can't invest in real estate. Like that's the thing. I don't have like they're busy ourselves. We're busy saving for our kids' educations. We're busy putting them into all the sports and keeping them busy and buying all these things. So we don't end up having much savings, and they think, oh, I don't have money to invest. But many of us do, because we're taking money, like, to kind of put it in RSPs so that we can pay less taxes. And but what about like pension funds? Can we do this with our pension funds?
Yeah, absolutely. So, a lot of people, for some reason, seem to think that their RSPs or TFSAs or their locked-in pension with their employer has to sit at that particular big institution, for instance. But arguably, that's not the case. 70% of what I do is assisting people with self-directing existing locked-in pensions, RSPs, spousal RSPs, TFSAs, periodically RESPs, and we would just self-direct them from, whatever portfolio they're in with whomever, be it stocks, bonds, and mutual funds, and self-direct those into typically Olympia Trust, being one of the largest trustees in the country for the private or exempt market. And then diversify accordingly from there into, one, two, half a dozen or more private real estate and alternative investment firms.
And what I love about the real estate world, because of course I'm in it and I'm really passionate about it, is I like the brick and mortar, that there's a like even as in these funds, we know that behind these funds is actually a building, land, there's dirt there. Unlike like the stock market, where my registered funds in stocks, it's like but as fast as I get it back up, it's like plummets back down. So I feel like it only moves because I'm feeding it, but I don't actually I'm not really seeing any money being made in it.
It's a very challenging world that we're living in right now. And again, this is the exact reason why we're seeing the smart money managers, the Harvards, Yales, CPPs, Tiger 21s, Omars of the world, diversify more and more into private real estate and alternatives. Typically they're all pushing north of 40% plus. And we're starting to follow suit finally. And it's because we can eliminate some of the politics, some of the emotion, and again, some of the volatility. So definitely, we're not ever looking to capture 100% in privates. This is a riskier marketplace more often than not because of time and liquidity and the fact you can't just push a button and get out. But if you do your homework and get invested into the right product, then you can do very well. And it's a great place to park somewhere between 30 to maybe on the high side, 45% of your portfolio. So in a perfect world, as an advisor, I would love to see folks, and again, everybody's different, but a 40-40-20 split. And what I mean by that is 40% in privates, 40% in publics, more often than not into portfolio management firms where you get that 100% liquidity, but a little less volatility, and then 20% maybe into insurance strategies and solutions.
Yep. So 80-20 rule almost. 40-40-20. Yeah. Yeah, that's
Exactly.
yeah. Yeah, awesome. So I spend a lot of money on the stock side in fees. What do those fees look like on in the public market side?
Another great question. It's almost like we loaded these up, but we didn't, folks. So yeah, I'll answer that twofold. First, clients do not pay dealing reps like myself directly. So there is a cost of capital, and that is built into the offering docs. So the asset managers and the funds specifically pay me. And so more often than not, that is why we request typically a 3 to 5 year time horizon. It's not locked in necessarily, but we do ask for that because there would be a small penalty if someone decided to redeem early. So you're not paying the advisor fees directly. So that's great. As far as registered funds go, yes, they need to be held in a trust company. And in this case, the bulk of the Canadians are holding their private holdings in Olympia Trust when it comes to RSPs, TFSAs, locked-in pensions, and so forth. They charge about $150 per year per account. And there would be a one-time subscription of $75 per issuing subscription. So per investment that a client's going into. But on an annual basis, yeah, you could have $1 million in there and you pay $150 in your RSP account. Whereas quite often you might pay 1 to 2% with the big banks, if you will.
Yeah.
So you do the math, that's a huge difference.
I think I'm paying 3.2% with Edward Jones. Yeah, so
I'll plead the fifth.
I think that's the but yeah. No, let's talk a bit. So I got really excited when we were chatting because I didn't realize, and I don't know if too many people realize. Let's talk about TFSAs. I always thought before I got into real estate world, I thought that my TFSA was just like a savings account that I got some benefits by not but I really wasn't earning that much. It's like big deal. I earned what 0.05% on that in interest. Like, what am I hiding there? What am I protecting? But talk about the advantages of like let's talk about TFSAs. And you told me that the limits have gone up and about that like one time money that you can put in. So can you
Yeah,
explain a bit
absolutely.
more?
So not to get into the political side of things, but I will say it's the one of the best things that the government has done. As Canadians, if you're eligible for all the years that the tax-free savings account has been out, you're allowed to contribute up to $95,000. So, many of my clients have a couple $100,000 sitting in their account, thanks to growth over those years. Arguably, I like to see TFSAs diversified into the private capital markets versus the public because we typically have a slightly higher targeted return. Of course, there's a little more risk on this side, so you have to weigh the risk and reward out. But again, if we're going to knock it out of the park, for example, you would want to do that in a tax-free savings account. Fast forward 20, 30 years from now, you could have $5 million in that tax-free savings account from whatever investments, but you'll never pay the government a single dollar, right? And that's just incredible because if you take the same risk on your investments and go into an RSP, yes, you get a tax advantage today, but all of a sudden your $1 million turns to $5 million later. And guess what? The government wants their handout, and there's a good chance that taxes are not going down. So of course there's some RSP meltdown strategies that can be applied, but if you had a choice between one or the other, more often than not, the tax-free savings account is a great investment vehicle.
Yeah, because well, I think now when this was we've been brainwashed to use RSPs so we can tax shelter and think. But the whole point of that is that the plan is that I'm going to be poor when I retire, so that's why I'm going to pay less taxes. But if you don't plan on being poor, you're going to be paying a lot of taxes still when you cash those in, right?
And that's so true, right? And I just thought I would comment on another great strategy that some of my clients and even myself deploy. So, for example, if you invest your money into TFSAs, but at the end of the next calendar year, you realize, man, the taxes are looking pretty heavy here, then maybe you look to roll those, self-direct them from that TFSA account into an RSP or maybe into a spousal RSP because perhaps your spouse is about to retire and be in a lower tax bracket. And so you can roll that TFSA at the end of the year, let's call it December 31st as an example, into that spousal RSP, get the tax break needed for that particular year. But come January 1st, you could actually then contribute once again to your TFSA account, topping it right back up. So again, it's a great vehicle when wanting to implement various strategies, which a lot of people don't typically think of. A lot of people put it there, they're on autopilot, and that's that, out of sight, out of mind. And there's nothing wrong with that. But you know what? If you're looking to deploy different strategies because of different tax brackets and tax consequences, there can be some real advantages, right?
And that's where, people like yourself comes in because I wouldn't think of these things. I don't know what's possible, but looking at how, you can look at that person and, like, again, I was talking about personalized real estate investing strategy. For each person, it's different. So it's what you need. How much did you earn this year? When are you retiring? All those factors come in, and there's some strategies you can deploy there.
100%. And you nailed it at the beginning of the podcast here. I mean, we're all very unique. And so when it comes down to actually getting into the nitty-gritty, and someone sits down with a dealing rep, we're doing a KYC. Know your client, getting to know you. Are you using personal money, corporate money, registered accounts? What's your time horizon? Are you looking for something with income, tax advantages, pure growth? What? And you kind of take that deep dive, figuring out what the best plan of attack is amongst you and your so-called advisor, if you will, right? And, again, depending on how complex it is, we might draw upon our partners in business. So we work with a number of CFPs, insurance advisors, tax specialists, so on and so forth, right? So we try to take that team approach more often than not.
So it sounds like you do more of a holistic approach to it.
Absolutely. Yeah, I like to call it a multi-styled family office. So again, surrounding ourselves with lawyers, accountants, tax specialists, insurance advisors, portfolio managers, real estate brokers, et cetera, right?
So I just want to get back to TFSAs because I thought of something. So because you were talking about top ups, etc. So it is possible. So you can do that lump sum up to 95,000, but then
Right.
you put that in. It doesn't mean that's it. That's all you can do. You can then keep topping up you can keep topping up every year. What's the new rate for the yearly?
Yeah, so up until last year, we were allowed to have contributed $88,000. And then Trudeau was kind enough to allow us another 7,000 for 2024. So now we're up to $95,000 in contributions that you could have made to date. And of course, we'll see what happens next year. It's supposed to continue going up according to inflation, but you never know, right? Um,
And what's the yearly
yeah.
top up amount now?
It will change year to year. This year is $7,000.
Okay, because it was 6,000, then it was 6,800 or something like that,
Yeah,
right?
he gave us 10,000 at one point and then
You
realized
took it
that a
back.
lot of people were putting all that money in TFSAs and that wasn't making the government any money because they were putting less in RSPs. So he backtracked a little bit on us there.
Okay. So, what else can you tell me about? What else can we talk about? That's all the questions I could think about. So, what are some other things that you know? I don't know what I don't know. So,
Yeah, no problem at all. I mean, at the end of the day, I mean, I think it's very important for people at the very least to educate themselves, right? If you're not familiar with the private capital markets or the exempt market, you have nothing to lose by asking questions, right? So look to a dealing rep like myself or someone else and schedule a Zoom meeting, sit down and get to know more about some of the many product offerings there. Little tidbits, for example, like if you and I bought an apartment, and it was 100% rented out, we would collect pure income from that and pay arguably at the highest tax bracket. If we had an apartment across the street that was done through one of the REITs, a mutual fund trust structure, that would be very tax advantageous and often is 70 to 100% return of capital. So anytime we can defer those taxes before our adjusted cost base hits zero, which might take 8, 10, 12, 15 years, is a huge win, right? So again, is it better to do it ourselves or not? Good question. There's something to be had, in scales of economy. So when you look at a few of the REITs on our shelf, we've got 40,000 rental units worth over $13 billion, right? And again, very tax advantageous, all paying monthly distributions, all income and growth funds. All of them have never had a negative year. They've never refused redemptions. So again, you don't know what you don't know until you start asking questions.
And you have that security that these people have been in the market for a long time. They know what they're investing in, unlike somebody in a newbie in the thing. You could invest with that, but then you take the chance that, that you could lose it all. While in these are, people that have been doing it for years.
You always do, and I mean, you're investing in real people with real businesses that are faced with real challenges day to day. So at the end of the day, you want to make sure, as mentioned, that you're working with a registered professional, that you have the right dealership behind them. So again, sharing my screen for 1 second, as it relates to Access Capital, we have an investment review committee behind us, and their job is to make sure that we got the right people with the right track record, with the right structure, that we have independent board of advisors, audited financials, that we're reviewing and understanding those financials and asking questions, that we know what the key performance indicators are, the loan to value ratios, the weighted debt, how much they can do, what they are at, making sure we're doing criminal checks, site checks, background checks, so on and so forth. And, it's all of these items that can help, really mitigate risk and provide for a better investment experience. But at the end of the day, there's no guarantees in any of these investments. Past performance is not necessarily indicative of future results, but you can always look in the rearview mirror and get a good idea and hope that, in looking forward, that we're going to produce those same type of results, right?
But we have the same thing. We can't predict anything in the stock market either. And the returns are way low, way less. So
It's the volatility that really is the most damaging over time, because you can earn the same rate of return over a 30-year period, but if one of them goes straight like that and the other one continues to go up and down, you'll have a different rate of return at the end of the day, or a different investment dollar at the end of the day, if you will, right?
yeah, so awesome. So much to think about, Clint, so much to think about. So I just wanted to, it was really important. I really wanted to have you here because, as I said before, a lot of people think that there's two things that I have all these registered funds and I can only invest it in the stock market and I don't have any control over it. I have to give it to a financial advisor, which is not the case. You can do the self-directed. You can invest in real estate, and real estate is not just being a landlord, where you're having to deal with tenants and toilets, but you can invest in real estate and have it done passively through your registered funds. So it and you're earning, really good returns, better returns than in the stock market. But just as you said, there's risk here. It's high risk. So that's why we get the higher returns.
Yeah, absolutely. And again, there's risks in everything we do. And short of a GIC, you can lose all of your money in almost any investment. But
Yep.
again, if you have the right management and the right structure and independent boards making the decisions, and you have certain policies written in place to protect everybody, then you can have a really great investment experience. And I will point out one more item here. A lot of people, when they sit down with myself, or I'm sure many other dealing reps, they're like, well, geez, we just looked at half a dozen products. These all sound great. What do I do with my $100,000 pension then, right? And it's that second, third, fourth meeting where you're getting to know the client, where you figure out the overall plan of attack. But what I tell people is just don't get too excited about run one product. At the end of the day, you want to diversify, right?
Mm-hmm.
So the bulk of my clients will go into 4 to 6 products day one,
Because
right?
if one takes a nosedive, then you've got the others still that's going, or some will be going up, and like you were saying, some will be, maybe straight lines, some will be going up, but you've got that. But if you've just got the one and it takes a nosedive, then you're
You want to take
you're at a
that
loss.
portfolio approach for sure, right? And
Hmm.
and that means in privates, in publics, in insurance, and then diving deeper. Okay, what am I putting my privates into, right? So I'm not putting them into one basket. I'm going to diversify them into multiple products. Be it a few REITs, because they're different geographies. One's low rise, one's high rise, one's more focused in Midwest Canada versus all across Canada. You
One's
know,
in US in Texas or something like that, right? Is that what
Correct, right? And
Mhm.
just to be clear, even though I represent assets that are across North America, all of the investment vehicles we represent are for Canadians from Canadian companies, and eligible for Canadian registered funds, right?
Perfect. So, Clint, can you pop back up on the screen for those that will see this, in YouTube or and on Facebook, how to contact you?
Yeah, absolutely. Hopefully you can see that now, Debbie. My
Yeah.
phone number is there, as well as my email address. And again, I welcome any conversations and love to try and educate and assist others. Hopefully, a few folks will join me for the ride, and I can tell you that I personally do lead by example. So I've been buying and selling property for 30 years since I was 21. I maintain half a dozen properties. Not sure if I like those tenants and toilets as much anymore, but I also love the passive investments that I represent, as well as the insurance strategies and solutions, and referring to many other professionals such as portfolio managers to help create a more diversified portfolio for my friends, family, and clients.
I definitely aspire to be purely on the passive thing. So that's my
Me too.
aspirations, is to take that active and eventually just get rid of all of it and make it all passive. So anybody that's already there, don't feel like you need to be doing active. We are those who are active are aspiring to be the the passive. And enjoy that time freedom. So thank you so much, Clint, and thank you for coming on your birthday. Happy birthday again. I hope you have a wonderful birthday evening. And I want to say thank you for everybody listening. And I hope you'll join us again for another podcast. And please, on for those on YouTube, please like and subscribe.
Thank
Thanks
you,
so
Debbie.
much.
Thanks, everyone.
Take care. Bye.